The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Just how many more shocks can this market take? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bailey Lipschultz. We're kicking you off to the closing bells here in the U.S., and it's red pretty much everywhere in the screen. If you're looking at equities, S&P 500 down 1%, going to close sharply in the red for the week. Obviously, crude has been the story, up above $91 a barrel. That's the highest level since late 2023. And keeping an eye on banks, everything around private credit impacting the entire ecosystem. KBW Bank Index down more than 2.5%, a big drag in the financials sector. BlackRock down more than 7%. So we are seeing investors not only dialing up bets on crude, but trimming exposure to anything around private credit and those AI risks that have been plaguing the entire software industry as we limp into the close with the final hour of trading in the work week. Romaine.
Yeah, shocks from AI, shocks from private credit, shocks from the Middle East, and now shocks from a stunningly bad labor market report. Let's get with the clear-cut facts as to what happened this morning. The number of people on non-farm payrolls contracted by 92,000 in February. That's awful. However, given a major labor strike over at the healthcare network Kaiser Permanente, as well as some massive winter storms, that weakness could prove to be temporary. Unfortunately, it's kind of hard to embrace that rear view silver lining when up ahead are all these economic ripples approaching the shore from the war with Iran.
It is a weak report overall, and you're seeing that in the bond market. And it is this tension, between the weakening in the labor market and then the near-term inflationary shock coming out of the oil price increase.
Those inflationary pressures starting to squeeze even tighter, with crude oil prices up 25% since the war began, up to around $90, reigniting stagflation fears, stagflationary scenarios that now appear to be the main headwind for stocks overall. In fact, almost 400 of the S&P 500 stocks are set to finish the week in the red, with close to 100 of those names down about 10% or more. Hotel and cruise lines among the worst, falling to their lowest level since November. Logistics stocks like UPS heading toward their worst weekly performance going back to August, and airline stocks, wow, now down the most since April. The S&P overall headed for its broadest base sell-off of the year, and believe it or not, its first back-to-back close below that 100-day moving average since at least May of 2025. Steve Sosnick joining us around the desk here in Studio 2, chief strategist at Interactive Brokers, to kick us off to the close. I'm not exactly sure where to start. I mean, let's start with the jobs report, because that was supposed to be the main catalyst for today. And there was a reaction to it. I mean, you saw a lot of people flocking back into bonds. I mean, that actually pushed yields down. I guess what was the idea? That we were going to end up with, what, more rate cuts?
Well, in any normal day, this would be the biggest news of all. But yeah, so I think the thought would be that the numbers were weak enough to maybe spur the Fed to consider more rate cuts. But remember where we are in rate cuts. We're now looking for one in September, as I believe the first one with a probability greater than one. That was as early as June, about a month ago. It was mostly July, but we've pushed it back. Actually, we got as far as October earlier this week. And we were looking more like 1.5 cuts for the year rather than 2.5 cuts for the year. So the mentality's changed. I think this is helpful for the people who are hoping for rate cuts, although I would say, a 20% jump in oil prices works against that.
One of the sort of arguments, though, amid all the chaos with everything else, the AI and the Middle East and stuff, was the idea that we had a relatively, at least a perception of a relatively stable economy. There are some people dismissing today's report, saying that this is definitely probably more of a blip rather than a trend. And we had Rick Reeder over at BlackRock on this morning who said just that. They said, look, a lot of temporary factors here that should smooth themselves out once we get the next report or two. Do you buy that?
To an extent. I mean, we're talking about, even when you say we missed by about 150,000 jobs this month, and then there was a revision of about 70,000 jobs, 220,000 jobs in a labor force of 170 million is really just kind of splitting hairs at the end. So I'll leave it be. It's better to look at a longer term trend, 3-month trend. The last 3 months, not looking so great, but let's see what happens.
What's the playbook going into the weekend and coming out on the other side on Monday? Obviously, as Romaine mentioned, no longer just AI, geopolitics, energy prices, inflation. What should investors be looking at and looking to either increase allocation to or cut back from?
this is one of these Rorschach test moments, Bailey. And I think what it is, you know, if you're looking at this going, oh my gosh, oil price is above 90, the situation in the Middle East is completely unraveling. The fact that we're only down 1% amidst these job numbers as well, I consider that a big victory. And the flip side of that is I've had people say, well, you know, this will probably end this weekend or it'll end in a couple of days. And I certainly don't want to be caught on the wrong side of the market because, you know, the lesson people have taken away, if nothing else, is every dip is a buying opportunity, whether it is or isn't, every dip being a buying opportunity and every rally being a bit of a chase. If we close here, this will be the fifth day this week, 5 out of 5, where we close significantly above our intraday lows. That tells you something about market psychology. If we're supposed to be, we may not be climbing the wall of worry, but we're certainly hanging on by our fingertips.
Hang on by our fingertips. But when you look at kind of the underlying dynamics, Romaine and I were talking before we opened the show, what's top of mind? Is it the AI exposure and the risks that the knock-on effect, if there is going to be dominoes to fall because of private credit, or is geopolitics trumping that?
Again, this is your point of view. If your point of view is I don't want to miss a rally, you're ignoring all that. If you want to talk about the wall of worry, well, this is like the Empire State Building because you know you've got the private credit worries. I mean, you've got BlackRock down like 7-8%. I mean, this isn't supposed to happen. So you've got private credit worries. You've got obviously oil price above 90, which we're not supposed to be dealing well with. All these factors. So there's a multitude of risky factors in there. Yeah. But underlying it all is this positive investor psychology of I need to be in it to win it.
But I do want to get your thoughts here on the feed through to energy. And we did have official settlement above $90 a barrel, something that hasn't happened in quite some time. I should point out in the same program yesterday, we were talking about the first official settlement at $81 or above 80 that we hadn't seen in quite a while too. So $10 in 24 hours, it's still in the news session, still rising higher as we get more headlines here out of Iran saying, with concerns about the Strait of Hormuz still being blocked and the potential for attacks if the U.S. or anyone does try to move ships through there. Is there a feed through to equities, a direct one?
A direct one, yes, certainly in terms of energy stocks and cruise ship. You mentioned cruise ships, airlines, et cetera. But eventually it feeds through to everybody because it's stagflationary if we stay up here because it's a big inflationary headwind and it's a problem in terms of if there are inadequate energy supplies or even more expensive, it harms growth. Yeah. So that is a big negative. One of the things I like to say to people about geopolitics because equity markets get geopolitics wrong all the time. Bond markets get it generally right. Commodity markets get it generally right. Equity markets lose sight of things. Yeah. But I like to give what I call the Microsoft test. What does this mean for Microsoft's earnings? Because equity markets are very good at earnings, revenues, dividends, et cetera. Yeah. For most of these geopolitical events, there really isn't one. And you don't have to use Microsoft. You could pick any.
No, I get your
company.
Point, though.
But now I have to say, if we're talking about no interest rate cuts, higher inflation, slower economy, that does have an effect on Microsoft.
But this is also a duration issue at this point because, I mean, everyone thought, I think the idea was that this war was somehow going to be tidily wrapped up, or at least the worst of it here. We're about to enter the second week of it. And based on at least what I've heard out of the White House, it doesn't sound like they're about to let up anytime soon, Bailey.
No, it doesn't. And it seems like, obviously, the question to Scott's point is, do you want to be long this weekend or do you want to dial back exposure? And if you're looking for areas that are safer, where are those? And the thing that's been interesting to me is that rest of world, or is that less appealing just given the pullback we've seen in the U.S. market?
I literally had a colleague whom I respect very much text me today internally and say, don't you want to be long over this weekend because they're going to solve this over the weekend and it'll be over and I don't want to miss it. So this is what's out. This is a big part of it. So here my job for 30 years was risk management, was thinking about what could go wrong. Your job is reporting news, and the news you're reporting is not particularly exciting, not particularly good. But yet this is the world we live in, where nobody, again, I keep stressing the psychological element, but I can't. I look at our customer activity. 23 of our 25 most active names were to the buy side, and it's been consistently, and every dip has been a buy. And again, we've had these rallies at the end of the day telling you that people not only don't mind going home long, they don't want to go home flat or short.
Yeah. All right, Steve, I have to leave it there. Steve Sosnick, Chief Strategist at Interactive Brokers. And a reminder, we are deep in the red, but well off the lows of the day still. Stocks right now on pace for their worst weekly decline since at least November. When we come back, we're going to continue our focus here on the economy. A conversation with Federal Reserve Bank of Cleveland President Beth Hammack. Our very own Michael McKee will be joining us in just a second for that, right here on The Close, right here on Bloomberg. Breaking news on the Bloomberg terminal. Oracle and OpenAI are apparently ending plans to expand that Texas data center site. This is Stargate. Remember, it was just yesterday where Brody Ford here at Bloomberg reported that Oracle was planning to cut thousands of jobs as it was dealing with the cash crunch from a massive AI data center expansion effort. And now a new report out by Brody Ford, Ed Ludlow, and Dina Bass saying that Oracle and OpenAI have scrapped plans to expand that flagship AI data center in Texas after negotiations dragged on over financing and OpenAI's changing needs. Ed Ludlow joining us right now. Ed, give me some more details on this. What's going on?
Yeah, so it's the Abilene site. You know, there's an agreement already in place to do 1.2 gigawatts. And what we're reporting is that Oracle has decided not to proceed with the expansion to 2 gigawatts. At the same time, our understanding from sources is that Meta has come into the equation and is negotiating in early talks with Crusoe, which is the developer of the site, to be the tenant, to take on, to lease that capacity of the planned expansion now that Oracle is going to walk away from it. What is interesting here is that we also understand that NVIDIA made a $150 million deposit or payment to Crusoe to ensure that whatever happens in that next phase of expansion in Abilene, it is their compute, their GPUs that power it, and not AMD's. So a lot of moving parts here. When we broke the story, you saw Oracle go from reasonable gains to now pretty firm negative territory. What I would say is that Oracle has a broader 4.5 gigawatt agreement with OpenAI. That's very much intact. They're proceeding with other projects. This is just focused on the Abilene, Texas site. Yeah. And so we will see whether Meta will come in and take on that additional capacity as it expands. But our understanding is there were some issues with how the site was operating, some financing issues, and also OpenAI's needs have changed. And you see all three of those names moving in reaction to this reporting, Romain.
All right, Ed, we'll cut you loose now. We may have to come back to you a little bit later. This is a big story now developing here on the Bloomberg terminal with Oracle and said to be scrapping plans to expand that AI data center down there in Texas. NVIDIA shares are now spiking lower here. They were already in the red, now down about 2.5%. CoreWeave down about 2%. Meta also lower by about 2%. In fact, the entire ecosystem in the AI space now oscillating pretty heavily as we move closer to those closing bells. We do want to go back to the economy and back to the Fed. The Cleveland Fed President, Beth Hammack, standing by right now with our very own Michael McKee. Mike.
Thank you very much, and we'd like to welcome Beth Hammack to Bloomberg Television and Radio Worldwide. You just finished a panel. You made an address basically suggesting that risks are two-sided now. You've been on the side of inflation being the biggest concern, but then we got this jobs report today that sort of makes the case for some of the doves on the committee. What did you make of it?
Well, I try not to make too much of any one individual number, and certainly this number was a disappointment, mostly because it means that there are more Americans who aren't working. That's what disappointed me in this report. We've seen the economy overall has been pretty healthy. It's been brightening. The outlook has been positive. When I'm out in the district talking with businesses, I hear them talking about their optimism and that they're looking to make more investments in their businesses, and they think demand is going to be reasonably robust. But we've had a labor market that I would characterize as stabilizing. It's been in that 4.3, 4.4 range for an unemployment rate perspective. Obviously, the headline jobs number has been the piece that's been a little bit weaker. When I talked to you last, it was August, which was the first of those reports where we saw more softening in the labor market. But it does look like it's been stabilizing. And I think part of that is due to the accommodation that we put into the economy towards the end of last year. And now we have a lot of tailwinds, I think, looking ahead in terms of the economy and in terms of growth. On the other side of our mandate, inflation has been above our target for 5 years. We've made virtually no progress over the past 2 years. We're still right around 3% on inflation. And so we need to make sure that we're maintaining a balance of policy that's going to help bring inflation back down to target while still supporting the labor market. So when I look at things broadly, to me, it seems like there are two-sided risks to rates.
Well, there is a question on Wall Street that came out in the last minutes where it was suggested that some members of the Open Market Committee wanted to put the two-sided risks into the statement. At this point, is monetary policy tight enough to address the inflation side?
It's a great question. I think we're right around neutral. There are a lot of different estimates of what that neutral rate is. To me, when I see the economy continuing to perform reasonably well, I take confidence that we're probably not being overly restrictive. When I talk to business leaders, they're still willing to make investments. They're taking out loans. The banks that I've talked to in the district see that their loan growth is improving. And so all of that says to me that we are around that neutral level and that we should stay at least around neutral to help make sure we're putting the right amount of pressure in bringing inflation back down to target.
So we basically can look at the next meeting as kind of a wash. It's too early to make any decisions based on what's going on with the war. And as far as you're concerned, you don't need any more accommodation right now.
Yeah, I'm just one person, but as I see it, I think we could be on hold for quite some time.
But as a voter, an important person, we're not going to diminish you.
I think all 19 of us are important.
So one of the things that's going to happen over the next few months is a new chair is going to come in. A lot of people talking about Kevin Warsh is going to lower interest rates, but one guy can't do it himself. It's, as you say, 19 people on the committee. So how do you think that plays out with a new chair, who's not Jay Powell anymore?
Well, I mean, there's been transitions in the chair of the committee since the body was founded in 1913. And so there have been a number of evolutions. And I think you saw the transition from Greenspan to Bernanke to Yellen to Powell. And I think this will be another transition and the committee will adapt. And I'm excited to work with the new chair. I think that whoever walks into that role, the chair seat is a particularly influential seat. They historically have tried to bring the committee together, get a perspective on where people are. And I have every confidence that Kevin, if he assumes the job, is going to do his absolute best for the American public, like all the rest of the 18 of us do around that table.
Well, he's wanted to make some changes, and one of them is a smaller balance sheet. This is kind of your area of going back to your days at Goldman Sachs. What do you think of that idea?
I think it's a discussion that we should have. I think there are lots of things that we've done for a long time. And one of the things I love about being on the committee and being part of the system is that we have really rigorous, really deep debates about what is the right thing to do, what's the best thing that we can do to support the economy. And so I think it's a fair conversation to say, should we have a balance sheet as large as it's been, or should we look at reducing it? What are the pros and cons? What are the ramifications? Typically, we don't do things very rapidly. We take our time and we make sure that we're thoughtful. The magnitude of the decisions that we're making are significantly greater than what I did in my previous life, so it's appropriate that we move a lot more slowly. But I'm excited to have these conversations. One of the other things he's talked about is our communication strategy. Do we have the right communication strategy? Should we be using more words in our statements or fewer words? Are the press conferences something? So I think there'll be a new leader coming in, like in any organization that has a new leader. I'm sure we'll bring fresh ideas, fresh perspectives, and it'll spark a bunch of really good discussions.
Well, from your old job perspective of looking at this whole system of the balance sheet and everything that's developed over the years since you went to interest on reserves, would it be very, very hard to change again, given the infrastructure that's arisen around this?
So I think when we talk about reducing the balance sheet, it's really about, are we going to be in an ample reserves regime or a scarce reserves regime, I think is really what the question is around. And obviously the details are going to matter on any particular proposal. But in order to maintain good rate control, if the banks demand a certain amount of reserves, we have to supply those reserves. Right now, we're doing that by holding treasuries on our balance sheet. If we move to a scarce reserve regime, we would do that by engaging in open market operations. And so there'd be repos rather than treasuries. Net, the size of the balance sheet is still the same. It's just the form of those assets that's different. The duration profile, the risk profile is slightly different depending on which format you have. And so I think it's a reasonable question to say, is it better to be in treasuries? Would we rather be in repos? That's a discussion that we can have. Away from that, the banks are going to demand what they want from a reserve perspective. A lot of that is driven by our liquidity regulations, by their payment flows, and by just their willingness and their desire to have safe assets on their balance sheet. And so there are a number of factors at play that are going to drive that size of what they want those reserves to be, but the form in which we're supplying them could change.
Let me go back to the making of monetary policy and ask you about when you go around the Cleveland district. What are you hearing from companies about their plans? We were told for a long time by all kinds of Fed officials that companies are saying we're sitting on our hands because we're waiting to see what's going to happen. Has that changed at all?
That's changed. Companies are no longer sitting on their hands. I think they recognized somewhere around last fall that we were living in a world of uncertainty and that was not going to change, and they had to keep operating their businesses. So when I was out in Akron a few weeks ago, we were talking with some business leaders, and they were talking about trying to go out and hire, saying if they could find 10 workers, they'd hire 10 workers because they're seeing the demand and they want to be able to meet that. What I hear most often in the district is that it's hard to find skilled laborers and tradesmen. And that's been a real barrier to growth for a number of the companies in the 4th District. If
they are considering raising prices, are we going to see more of that? We did see a big jump in goods prices in the last PPI. Yeah, it's, the pricing pressures have been reasonably consistent. As we talked about, we've been closer to 3% than our objective of 2%. It's coming from a variety of sectors. Some of it is driven by energy costs. Some of it is driven by insurance costs. I hear that very regularly when I'm out in the district with businesses, that those two pricing pressures are really significant. Talking to a grocer, they were talking about how their energy costs have been really elevated and they have to factor in how much of that do they want to put into the food costs that they're selling things for. And so businesses are continuing to really deal with these pricing pressures. One of the things, if you look at the data, is you do see PPI significantly higher than CPI, right? So the producer prices are going up a lot more than the prices to consumers, which means that businesses are buffering that. That's eating into their margins. And one of the questions that we continue to ask businesses is how long can that persist? At what point will you need to pass on those pricing pressures? Right now, they've been nervous to price on more because they're worried about the demand outlook, and they don't feel that they necessarily have all the ability to price it on without impacting demand. But that's something that we'll be keeping a close eye on. What are you discerning from people in your district, both in the executive suite and then regular people, about the war and the price rises, which is going to be gasoline for most people in the short run, because it could have an effect on consumer sentiment. Now, we know they're not as related as they used to be, consumer sentiment and consumer spending. But do you worry that this could lead us to something like stagflation? We run in Cleveland the Center for Inflation Research, and our team has done a lot of work around what the impact of higher energy prices is on consumers. And there is evidence to show that it can impact consumers' outlook, their spending, and their willingness to invest. I think the economy right now is in a reasonably good place, but obviously all these developments, the macro developments, bear watching. The impact of oil prices, it's too soon to say. What I'm going to be looking for is how big and for how long, so the magnitude and persistence of any potential increase in oil prices. What's that going to mean? How long is that going to persist? And how will that flow through? It could be that it puts more persistent inflationary pressure there, but it also could mean that there's a drop-off in demand because of it as well. And so there really are two-sided risks that are worth watching. Beth Hammack, thank you very much for joining us, the president of the Federal Reserve Bank of Cleveland. We'll send it back to you.
All right, thanks there to Michael McKee out there. We do want to turn back to markets here. Just a quick note here. We had that breaking news a little bit earlier. The Philadelphia Semiconductor Index now at session lows, down about 4% on the day, and that's dragging down the broader market. We do want to take a look at one particular stock, and that is Trade Desk. It is down on the day, but it's been oscillating all day long here. In fact, it's actually setting up for its best weekly gains in about 10 months. So remember, just about a week ago, it reported earnings, and it had its worst day in 7 months, and that was largely because of fears about the disruption from AI. Since then, we have learned that it might actually be working with OpenAI in a more collaborative way that will maybe potentially could be a little less disruptive. Barton Crockett is a senior research analyst over at Rosenblatt Securities. He joins us now to talk a little bit more about this. You've got a buy rating on the stock. Talk to us a little bit about what we actually know, because like I said, a week ago, it was all that basically AI disruption had finally come for the ad tech space. And then now, based on reports from The Information and others, maybe there's a little bit more cooperation there?
Yeah, look, I mean, we don't know if there's anything real there or not. I mean, the reports were pretty vague in terms of just the specific reports. But we do know, at least from our perspective, that it makes a ton of sense for OpenAI to work with ad tech. We do know that at the start of this week, they formally and publicly, began to walk down that road by signing an agreement with Criteo, which is an ad tech specialist in kind of retail media, which is the first kind of third party that OpenAI has brought into its trial, and they brought Criteo into the trial. And we know that Fidji Simo, the application CEO at OpenAI, used to work at Instacart, before that at Meta, but at Instacart, she ramped an advertising push that's been very successful, and she leaned meaningfully on ad tech, including Criteo and including the Trade Desk. Mm-hmm. It makes sense to bring ad tech in because OpenAI, is not in the ad business, and they could use all the help they could get to try and compete with Google. And everyone else that's moved into advertising has signed them up, whether it's Netflix, Spotify, Roku, and they're very happy with bringing these kind of specialists in to cast a wide net, bring in as much ad demand as you can into this programmatic world. So I think it makes a ton of sense. And it would really go a long way if we saw these things kind of formalized to kind of rebut the fear out there that the large language models are kind of disintermediate ad tech. If they're in fact partners, that kind of argues the other way. So it would be very helpful sentiment-wise, and down the road very helpful revenue-wise, because I do believe that the advertising through LLMs will be search. I mean, what's in search today will be, and all in Google will be spread between others. And so over the longer term, that could be an important revenue stream as well.
Yeah, Barton, just looking at it, though, the best performer in the S&P 500 this week, as Romaine mentioned, up 20%, still down pretty sharply. Year to date, down about 25%. Tenth of the shares are sold short. Is this week's move short covering? Is it optimism that they are figuring out the path forward in an OpenAI-led world? And is it warranted?
Look, I think that the stock is too cheap here. I mean, at trading right about 9 times enterprise value to EBITDA for a stock that a couple of years ago was like 30 to 40 times. So it's pulled back a lot. We launched coverage, a big chunk of the way through the downdraft, but not all the way last year in the spring. But this multiple for a company that's growing EBITDA revenues in the teens plus, a leader in programmatic, a leader in the transition to connected television advertising, it's a good entry point if you believe that the business secularly is durable. And one of the key sources of debate is the LLMs. What does that mean? And I think that'll be answered constructively. The other question is, can they be in this field while Amazon's also pushing into it? And I think that'll be answered affirmatively as well, because it's a large universe, and Amazon's going to take care of its knitting first, and there'll be space for an independent giant like the Trade Desk. So, I think there's an opportunity here. I don't know that what we saw yesterday was much more than short covering. Probably takes a bit more kind of wood to chop to have our belief kind of broadly accepted, but we think we'll get there.
I am curious, though, when we talk long-term, Barton, about kind of the shifts that we're starting to see with regards to AI in the ad tech space here. Is there an inevitability to this, the idea that maybe you won't need, a standalone third-party ad tech company, at least if you're, one of the bigger players, like an Amazon, Microsoft, et cetera?
Yeah, look, I mean, the giants that have moved in more recently that didn't already have an ad kind of Salesforce and infrastructure built up, they've been leaning heavily on the ad tech guys. I think that the concern that the LLMs are kind of take over this, I think, is misplaced, because programmatic advertising is transaction processing at the trillions of transactions per minute kind of pace. Yeah. And an LLM doesn't do that. An LLM is a thinker that doesn't care about how quickly it thinks necessarily, certainly not at that level. So they're optimized for different things, and so I think they're more compatible than they are competitive.
Barton, always a pleasure. Barton Crockett, Senior Research Analyst, Managing Director over at Rosenblatt Securities, taking a look at one of the more volatile stocks here on what has been an incredibly volatile week. With just about 30 minutes until we get to the closing bells, we are counting you down, and we started this session, Bailey, it looked like we were actually starting to see a little bit more buying of the dip into the close, but a big headline just a little while ago showing further cracks in the AI space, seeing the Philadelphia Semiconductor Index hitting session lows, and of course, one of the biggest players in the Philadelphia Semiconductor Index, is also the biggest weighting in the S&P 500, and that's NVIDIA, which is down about 6%. And that's a big reason why we're now retesting session lows.
Yeah, as you can see, a sea of red, NASDAQ 100 down 1.5%. This is not what investors would want to see. We were talking with Mr. Sosnick from Interactive Brokers just a few minutes ago about how we had been seeing a market that was rallying off its intraday lows. If you look at NVIDIA right now, as you mentioned, down more than 3.5% more than 3% on the day, dragging down the market. It does seem like crude's still sitting above $90. It's going to be something to keep an eye on.
Yeah, and of course, these are the big catalysts. We talk about this idea here of cracks in the AI trade. Obviously, a little bit earlier, you had pointed out BlackRock having a rare plunge in stock, something I don't think we've seen in maybe 9 or 10 months. The cracks in the credit market, and of course, all of the concerns right now about the war in Iran.
It's really just piling up, as you mentioned. It seems like markets participants are looking for reasons to sell, and there is no shortage of them. Again, with that latest hot headline coming on Oracle and what that could mean in providing a bit of selling pressure to NVIDIA and the entire ecosystem for AI build-out.
Absolutely here. And of course, as we head into the weekend, we've already heard from the President of the United States several times here that he is not about to let up just yet on Iran. The situation over there adds to other 7 countries that the President has now used military force against since his return to office. And it's raised a lot of questions, particularly for investors here, as to whether this is something we have to get used to or whether this is something temporary that will to pass. Elliott Abrams joins us right now. He actually used to work for the president during his first term, a former special envoy for Iran. He was also a special envoy for Venezuela during the first Trump administration. He's now a current senior fellow for Middle Eastern Studies at the Council on Foreign Relations. Elliott, first, let's start with Iran first here, because there's been a lot of discussion here about what comes next. We've seen the aerial assault, the missiles flying over, but a lot of questions right now about will there be boots on the ground, whether it's U.S. boots or Israeli boots, but also this idea that Trump himself has floated about trying to maybe potentially arm U.S.-friendly insurgents, including the Kurds, to help with regime change in that nation?
I don't think there's going to be U.S. boots on the ground. I don't put out of mind a commando raid, where 10 or 20 or 30 people go in for a few hours. But if people are comparing this to Iraq or Afghanistan, that's wrong. That's not the way Donald Trump thinks. He lived through those, and he's not going to do that. Now, there are substitutes, maybe, and one of them could be the Kurds. So I don't put that out of mind either, that he could decide we need some armed group on the ground. It's not going to be us. So they are the obvious candidate. I don't think you'll see significant numbers of Israelis either. For one thing, they're doing some on-the-ground activity in Lebanon. For another, it's very far away from them, and that's not how they fight that kind of war. They don't do that kind of long-distance fighting.
But it gets to the question then of exactly sort of what the goal is here. I mean, we've seen our military might, but that only goes so far. At some point, you have to start talking about a functioning government and ideally a government that would be friendlier to the U.S. and the Middle Eastern, other Middle Eastern nations out there.
Well, one option is what the president did, and he obviously is very happy with in Venezuela, where somebody within the regime is willing to give him what he wants, make the compromises that the Ayatollah Khamenei would not make, and that the whole government of Iran would not make until this war. Another possibility, of course, is another uprising, and that would really put pressure on the president. What happens if hundreds of thousands of Iranians rise up as they did in January, and the regime starts shooting them as it did in January? Will the president act to prevent that? And I think the answer is yes, he would act. But again, it would be from the air. There is a possibility that the country just falls apart. That is, you see the inability of the central government to really have any sway in different parts of it. For example, Iranian Kurdistan. All of those are possibilities, and it's hard to see right now how it is going to turn out. And it is hard for the Iranians in the regime to make decisions, because they know that if they ever get together to have a meeting to make such decisions, they're likely to get hit by the United States or Israel. They're going to be having Zoom meetings for a while.
Well, Elliott, what do you want to see, or what are you looking for as we enter the weekend? We saw the strikes happen late last Friday here in New York. time. What are you looking for as we head into a critical stretch, or is it not critical?
Well, I think it is. It's week 2, I think, looks a lot like week 1, except in 2 ways. I think the Iranians are going to be less and less able each day, less this weekend, less Monday, Tuesday, less able to attack us, Israel, our Arab allies, their neighbors, because we are really suppressing their ability to do that. We're going after their missiles, going after their launchers especially. So there's less of that. I think that that's critical. And the second thing is we will be using a new or older class of weapons. We've been using things like the F-35 because they are able to avoid being shot down. But once we've completely suppressed the Iranian anti-air ability, which we're pretty well doing right now, we can use older machines like the B-52, the B-2, that can drop more ordnance. So there's more and more.
Yeah.
It's going to
so
be
I have a question, though. Elliott. And this, I mean, forgive me if this is a bit selfish and it focuses a little bit more on the market's concern here. I understand there's a broader aim here. But when do we get to a point where the Strait of Hormuz is open, the flow of oil and gas is back to normal? Because all this firepower and everything else, it does not necessarily help, at least not in the immediate term, in getting that back open. It's closed. It's effectively closed. When does it open?
Yep. I'll give you a number, though it's probably foolish to do so, about 2 weeks. I think we need to suppress the rest of the Iranian Navy, their fast boats, cigarette boats, their ability to mine. And I think that takes another 2 weeks.
At what point does cost matter, or does it not matter from the U.S. perspective as it relates to this ongoing war or conflict, depending how you want to break it down?
You know, the deficits have been so gigantic that the cost of this war is a marginal error. I don't think that's going to control how long this goes.
So, Elliott, when we talk about also this idea of the U.S. being involved in a lot of different areas, Iran obviously being the most significant at the point, but obviously we have Venezuela, who knows what we're doing in the rest of the Caribbean as well here. Does it get to a point where our military becomes a little bit too stretched?
Not unless something perks up in Asia. That is, we are not now really involved militarily in Venezuela. We're doing a little bit going after boats in the Caribbean, but it's not a real stretch for the Navy. This is a real stretch for the whole U.S. military. They can do it, but we're not in the position anymore of fighting 2.5 or 3 wars at a time. So as long as nothing is added to this, we're fine.
Yeah. A lot to keep an eye on and a lot to monitor. This time last week, crude was around $67 a barrel. It's north of $90 a barrel. Our thanks to Elliott Abrams. He is Senior Fellow for Middle Eastern Studies at the Council on Foreign Relations and was a formal special envoy for Iran during the first Trump administration. Well, coming up, investors casting stones at BlackRock as the asset manager's $26 billion private credit fund limits withdrawals. It's the stock of the hour. Up next, this is The Close on Bloomberg. Our stock of the hour is BlackRock. Shares down sharply after the asset manager limited withdrawals for one of its biggest private credit funds, the $26 billion HPS Corporate Lending Fund. Building on that wall of worry facing the likes of BlackRock and Blue Owl about the risks involved in private market investing. Let's unpack the action with Bloomberg TV markets correspondent Norah Mulinda. Norah, it feels a bit like Groundhog Day, where whether it's restricting withdrawals or marking books down sharply, what's new with BlackRock and how does it stack up to what we've been seeing and tracking?
Well, I think that this is essentially the clearest example that we've seen of gating from a private credit fund since the volatility that we saw late last year. So you are seeing a bit of uncertainty playing out right now in the market. I mean, we did see the high profile collapses last year, raising questions about underwriting standards. And so you're really seeing that coming up and reemerging as we think about some of the concerns that people have about the private credit market. We know that we did see banks pulling back and really private credit ballooning. Right now, we know it's about a $1.8 trillion industry. So people are really just thinking about the quality of credit and how it relates to any sort of things that we're thinking about moving forward?
This gets to the idea, too. I mean, we were talking a little bit earlier. There's another story about Blue Owl and some of its exposure to whatever happened with MFS, and the idea that we've seen, at least in the credit markets, the credit default swap markets, a lot more people now looking to kind of hedge themselves in this space here. I know we haven't gotten to the point where this is broad-based in terms of being, I hate to use the word systemic, but that is always the fear, is that there could be potentially some contagion risk here. Have you heard from any investors that have even brought that up?
So I haven't really heard this as being some sort of widespread thing for people to worry and be scared about. It sounds as though it's essentially a stress test for the market, and you're seeing investors trying to figure out how they really want to assess the situation at hand. I mean, there's kind of this core tension in the private credit markets in that investors get higher yields, but they give up liquidity. And so when you see redemptions rising, as we're seeing right now, that's kind of when that trade-off becomes hyper visible, if you will.
No, when does the music stop, though? Is this something that we are going to continue to track in the coming weeks, months?
It seems as though, from what I'm hearing from my sources, is something that people are going to continue to keep an eye on, but it doesn't sound as though it's something for people to feel overwhelmingly alarmed about. But you are still seeing those jitters playing out in the market if you take a look at the share action from both of these names that we're talking about.
And it gets to the broader question, too, that what's happening there, there's also all these other things going on, too. I mean, we're talking about a broad market here on this Friday afternoon that's now retesting those session lows, the VIX testing those session highs. So you have people just skittish overall about everything. And, of course, it becomes a sort of sell everything mentality, including, of course, in the private capital space, which, of course, as you pointed out, because of the structure of a lot of those programs, not actually something you can easily sell or get out, as we've seen with the BlackRock gating on the redemptions.
Right, and to that end, that's what you're seeing in terms of the action if you look on the equity side. So, I mean, we do have a downward day, but you see some of these individual names, you're seeing a lot of the stress really being exacerbated in this moment.
And you're also starting to see yields, which had been in the red, start to perk back up into the green. A lot to break down here on this Friday afternoon as stocks now reeling. A lot of people questioning what they want exposure to heading into the weekend. A conversation with John Belton at Gabelli when we come back after the break.
I try not to make too much of any one individual number, and certainly this number was a disappointment, mostly because it means that there are more Americans who aren't working. But it does look like it's been stabilizing, and I think part of that is due to the accommodation that we put into the economy towards the end of last year, and now we have a lot of tailwinds.
Cleveland Fed President Beth Hammack speaking a little bit earlier right here on The Close, counting you down to those closing bells. Romaine Bostic here alongside Bailey Lipschultz on a day where we saw markets try to claw back some of the losses, but now as you get closer to those bells, Bailey, it looks like they're really starting to get weaker in the knees.
Certainly getting weaker, and it feels like the economic data this morning was a lifetime ago. The S&P down 1.4%, as you can see. Banks really dragging on that. We are seeing a bit of an underperformance in the Mag 7 names. Obviously, that coming after the Bloomberg News story that Oracle and OpenAI ended their plans to expand a flagship data center. So that's sending a bit of ripples across the entire ecosystem of AI infrastructure. NVIDIA under pressure, CoreWeave, pretty much anyone who makes or has something to do with GPUs under pressure.
Absolutely. And in the cross-asset space, we should point out here that yields on the longer end of the curve now starting to get back into the green here, setting up for what's going to be one of the biggest weekly sell-offs that we've seen in long-dated treasuries in over a year. Oil prices now at $90 a barrel. That includes WTI, not just Brent crude here. And remember, it's not just what's going on in the oil space. Aluminum prices headed for one of their biggest weekly gains in quite some time. And don't even bother taking a look at diesel prices and natural gas over there in Europe. The VIX now at 29, right around session highs with just about 8 minutes into the closing bells. John Belton joins us right now, portfolio manager and managing director for growth portfolios over at the Gabelli Funds. And John, we always talk about investors sort of climbing this wall of worry, but it's like as they climb higher, it's like the wall just keeps getting taller. What's going on?
Yeah, it's been a crazy week in the markets. I think, market participants really just kind of waiting to learn and see how this situation in the Middle East is going to unfold. I think the market's initial reaction has been rates higher, dollar stronger, oil higher, discount rates higher, impacting equities to the downside. I think that's a reasonable initial knee jerk. But yeah, we'll see how it unfolds from here.
I'm curious, too. I mean, and then look, I know I always with the caveat that you and most of the folks we have on this program are longer-term investors. You're looking much more at some of the structural issues there. But when you see sort of, I guess, these short-term moves, particularly a short-term move that I think a lot of investors at the start of the week thought would sort of abate relatively quickly, when does the short-term start to become a concern about your long-term goals?
Yeah. No, I mean, I think every situation's different. I think one thing I'm thinking about here is, the impact on oil prices and when does that leak into, at what point does that leak into the real economy? And what I'm really focused on for the longer term is, to the extent that oil prices stay higher for longer, does that start to leak into inflation expectations? And does that derail this kind of disinflation story that's been playing out for the last, call it year and a half? I think that is, to me, the most actionable risk to equities as things stand today. And I know, some of the central bank officials that have been talking over the course of the last couple of days have been talking about the same dynamic, but that's what I'm watching for equities.
Well, John, now we only see a first rate cut coming in September. This is a market, at least when I talk to people putting cash to work, that has been betting on rate cuts coming to fruition relatively quickly. Where would you be pivoting or putting your cash to work in a market with that dynamic?
Yeah, well, I'll leave that to the smarter asset allocation people. Then I'm just an equities guy. But I do think you've had some expectations for rate cuts priced out over the last couple days. You've seen the longer end of the curve, as you were talking about before, tick a little bit higher, come under some pressure. That seems like a reasonable initial reaction to me. But again, I'm thinking about, for the stock market, for companies, for consumers, for businesses trying to plan investment projects, how long does oil stay elevated, and to what extent does that impact inflation expectations?
But how does that dynamic add to the uncertainty that we've been tracking as it relates to AI impacting software, as it relates to potentially pulling back from spending of AI infrastructure? What parts of the market then are protected or insulated from that aren't already crowded?
Right. I mean, it's interesting because, ironically, the AI story is quite separate, I think, from the conflict in the Middle East. I think the AI story is a little bit idiosyncratic in that way. This is an investment cycle that really continues to surprise to the upside. It's interesting that you had this headline about the Stargate facility in Texas just hit this afternoon. But yeah, I think the AI investment cycle, to me, seems sort of independent of what's happening, at least for the foreseeable future. These are investment dollars that are going into the ground this year, next year, we'll see thereafter. But the focus in kind of for tech stocks is still the return on all this spend. Is all this infrastructure generating revenue growth and profits for companies that are building the infrastructure?
Is it, John? Or is it going to soon?
Sorry?
Is it actually generating a return, or is it going too soon?
Yeah, no, I think I still think there's kind of a misunderstanding out there that my view is there's 4 really large commercial use cases operating at scale today. In terms of what this AI infrastructure is supporting. There's digital advertising or digital media, there's cloud computing, there's productivity assistance or chatbots, and now, as we've learned over the last couple months, there's agentic coding tools. And those 4 use cases are all tens of billions of dollars each in new revenue that's been generated from the AI infrastructure. So I do think companies that are operating those businesses are already generating really nice returns. Now, some of the CapEx is going towards more speculative use cases, towards model training and towards different applications that are kind of further out in terms of when they're going to start to produce returns. But I think the early data points that we have are, by and large, very positive. And by the way, we got some very encouraging data from Anthropic and OpenAI about their revenue growth that they disclosed this week.
Yeah, and we're also still talking about the potential for some potential IPOs in that space. We had a headline just a little bit earlier on this show here about AI chip maker Cerebius said to tapping Morgan Stanley for a $2 billion IPO. John, always great to catch up with you. I hope you get some rest this weekend. John Belton, portfolio manager, managing director for growth portfolios over at the Gabelli Funds. Let's check back in here, Bailey, on the broader market with the S&P down 1.3, the NASDAQ composite down about 1.5, Dow Transports, woof, 3.5% lower.
And you're seeing everything get hit, right?
Yeah.
So semiconductors down almost 4% on the Philadelphia index, but we are seeing weakness in travel stocks because of the impact of oil and the ongoing war. Mm-hmm. And the VIX getting back towards 30. Yeah. That's critical to me.
Absolutely. Something to keep an eye on. A full breakdown of all of your cross-asset market action here on this Friday afternoon. It's a global simulcast, and it starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Bailey Lipschultz. Katie Greifeld has the day off. We're taking you through to the Closing Bell with the global simulcast. Carol Massar and Tim Senovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and YouTube. We started off this week, Carol Massar, with a lot of investors sort of brushing off some of the broader concerns about what was going on over in Iran. But here on this Friday, apparently the bad news, just a little bit too bad to ignore.
Yeah, I mean, we're looking, going into the weekend, it's not like we saw investors coming in and buying the dip on this Friday. And we're looking at maybe 2% lower on the S&P for the week overall, about 1% or a little bit more than 1% down on the NASDAQ 100 for the week overall. A lot of worries. And we keep having guests on, I think, concerned that certainly the higher energy prices are going to stick around and that this trying to wrap up this war is going to take longer than shorter.
Yeah, I can't believe that here's where we are with oil, Bailey, moving so much higher in such a short period of time, with WTI another 12% higher today. I couldn't believe this, reaching its highest going back to the fall of 2023. So we're seeing $90 a barrel for WTI and $92 a barrel for Brent crude right now.
And certainly the knock-on effect, what that means for the U.S. consumer, as you mentioned, a 35% jump in 1 week for crude. What does that mean for people when they go to the pump, and what does that ultimately mean as the knock-on effects happen with the actual goods that people are purchasing?
It's already starting to show up at the pump, and of course it's not just oil and gasoline. You're also seeing natural gas prices, particularly over there in Europe, now up the most on a weekly basis since 2022. Aluminum prices having their biggest weekly increase since January of 2023. All of these things, of course, feed into the economy. Don't forget, we're going to get a CPI report here in the U.S. next week, a CPI report that is not going to actually reflect what happened over this past week. As we walk you through the closing bells here, the Dow down about 450 points on the day, a loss on the day of about 0.9%. It's lower on the week by about 3%. The S&P 500 down 1.3% on the day and about 2% on the week. The NASDAQ composite and the NASDAQ 100 each losing about 1.5%. And the Russell 2000 giving back 2% on the day and about 4% on a weekly basis.
All right, guys, let's go to the S&P 500. No surprise to see most names in that average lower today. We've got Bailey 357 to the downside, 145 actually moving up on this Friday, one unchanged.
Yeah, looking at the sectors, a lot of red. Consumer staples and energy outperforming, probably unsurprising to most people watching the program, but certainly a lot of weakness. Consumer discretionary, materials, tech, financials all rounding out the worst performers. Definitely a market where investors want to dial back some of their equity exposure going into the weekend.
All right, guys, let's go do some individual gainers, if we may. Marvell, that is your number one gainer in the NASDAQ 100, a gain of about 18% for the Friday trade. Chipmaker saying its year-over-year revenue growth rate will accelerate each quarter throughout fiscal 2027, so definitely seen as a bullish sign, but also a bullish target that shows soaring demand from data center related applications. So some enthusiasm on that and what has been some nervousness, certainly, with the AI spend trade. Hey, let's go on over to Costco. This was a top performer a little bit earlier in the NASDAQ 100, but still finishing the day with a gain of about 1.6%. Quarterly profit rose more than expected. Membership fees, something that was being watched closely, totaling $1.36 billion during the quarter, beating expectations. And the company says it's gain market share as its bulk sizes and unique selection of goods draw in shoppers looking for value. I also heard something about selling cakes or something, that apparently that is something of interest. So anyway.
Cakes?
People love
they never sold
their Costco
cakes?
cakes.
I guess it's a strategy going forward. I don't know. I mean, who doesn't love a cake? Let's go on over to Boeing, up about 4%. Number 2 gainer. I know, no segue there. Number 2 gainer in the S&P 500. Boeing closing in on a 500.
Cake delivery, Carol. That's the segue.
Cake delivery.
On a plane.
On a Boeing. Wow. No moss grown over there. Well done. Well done. He's always here for me. Boeing closing in on a 500 aircraft order for 737 MAX jets to be unveiled when President Trump travels to Beijing for his first state visit to China since 2017. Two sides are said to be in talks for a wide-body sale that includes about 100 Boeing 787 Dreamliners and 777X jets, which would likely be announced at a later date if this materializes. Keep in mind, this is not a confirmation. It would cap years of negotiations between Boeing and China's airlines and a lengthy order drought from the world's second biggest aviation market. This is big news if this ultimately happens.
It's a huge order.
And it's a huge market for Boeing. And as we know, China is also working on developing its own jet market.
Yeah, the COMAC.
Yeah.
Okay.
This guy loves planes.
To compete with the 737, let's talk about some alternative asset managers, including BlackRock, that took a hit today, down 7.7%. This after a series of negative private credit events stirred fresh concerns over the health of the industry. For BlackRock specifically, it was about the company, the asset manager, curbing withdrawals from its $26 billion HPS corporate lending fund after client requests for redemption spiked. It capped repurchases at 5%. It just adds to the worries that have been plaguing the private credit industry, and we saw other alternative asset managers fall today as well. Taking a look at airlines, because they have been under serious pressure in recent days over the war in Iran. We saw travel stocks take a hit. Online travel agencies are sliding too. Oil prices higher. That's a bad thing for all of these companies. Also, add on that jobs report that we got earlier today, and that could mean a consumer that is less willing to spend on stuff like this. The airlines industry, and actually airline stocks, down a little more than 20% from the highs just about a month ago. This is the S&P 1500 Airlines Index. That's down 22% from February 6th. So that's officially in a bear market. We also did get a note from an analyst over at Deutsche Bank that said that the price of jet fuel and oil, the spread between those during the war, poses an existential threat to U.S. airlines. So keep an eye on airlines as we do enter a bear market for that industry. And finally, shares of Gap taking a hit today, falling more than 14%. This after the company reported fourth quarter sales and profit that came in slightly below expectations. Old Navy and Athleta missed comp sales estimates. Gap and Banana Republic did beat. The company, though, forecasting a better profit than expected for the current year, and sales within estimates.
Yeah, and just an honorable mention, too. I just want to point out the chip stocks here. We did see the Philadelphia Semiconductor Index close down about 4%. And, of course, a big drag lower here because of a lot of those issues with apparently whether that AI spend is continuing. A great scoop earlier today that Oracle and OpenAI apparently dialing back their plans for that Stargate, that big Stargate data center down there in Texas. Meanwhile, we take a look at the yield space, and it was quite an interesting week. In fact, the biggest weekly sell-off that we've seen in benchmark Treasury yields since at least last April amid all of the Liberation Day ructions. Those are the numbers on a daily basis. And the reason why they're basically flat is because there was really the push-pull between the concerns about what's going on in the Middle East and concerns about, of course, what's going on with that jobs report. Of course, a jobs report that would actually suggest the potential for a cut in rates. But, of course, the inflationary pressures and what's going on in Iran actually maybe potentially making the case to actually hike rates. Overall, we're higher on a weekly basis on your 2-year by about 18 points, on your 10-year by about 20 points from where we were just last Friday.
Yeah, I think we're at this interesting moment in time, and I think everybody says, I was reading a Bloomberg column, we have to get an idea of how long this war is going to last, because that's going to certainly determine the impact. I mean, we're looking at what? WTI crude up almost 40% this week alone. Yeah. So, you think about the jobs report this morning, that was weaker than forecast. You've got inflationary pressures that are still out there. Dare we say stagflation? And you just think about the predicament this presents. not only for the U.S. economy, but the global economy and for central bankers around the world.
We spoke to Ellen Wald of Transversal earlier. She wrote the book on Saudi Arabia and Aramco, Bailey. And she said if this crisis, at least from an oil perspective, from an energy perspective, doesn't get solved next week, we're already on the cusp of a crisis, and we could see a full-blown crisis. She said we could see $120 a barrel oil in a very short period of time if this doesn't get figured out.
And I have to imagine the knock-on effect, like we've been talking, what does that ultimately mean for inflation? What does that mean for consumers? And certainly when you see a VIX that's getting back towards 30 and you see investors selling down companies exposed to the AI bubble, what does that mean?
Well, but also on the energy front, too. I mean, we talk about that $90 a barrel. 91, Carol Massar. We were at 81 yesterday. And we were like, what, at like 60 just a little while ago. But it's already fed through. I mean, if you look at on your Bloomberg terminal, AAA gas prices on a weekly basis, they're up by about 10 to 11% here. That's the price that you see at the pump, the average price, we should point out. But it's actually now up 6 straight sessions. It had already been rising prior to that. In fact, it had actually been up for about 4 straight weeks prior to this week here. And that starts to become the real impact. You know, the potential economic drag that I think a lot of us were hoping we would avoid. That's why you had folks like Mohamed El-Erian talking about stagflationary winds blowing. And I don't know if you saw all the Fed speakers that Mike McKee had on today. I mean, look, it's front and center. And when's that meeting? That's like in a week and a half where they got to meet and start talking about this stuff?
Yeah, exactly, right? And so what do they do? So, you know, with inflationary pressures still above the Fed's target, it continues to be that way. You've got to kind of assume that the Fed is going to be very careful and certainly not do anything, certainly not a cut, but certainly, you know, have to be on their inflation watch, right? Exactly.
Yeah. What does Kalshi say? Are they going to pay out if I win?
It's a good question.
Are you on Kalshi?
Too soon?
Are you on Kalshi?
No, that'd be illegal.
Okay, I'm just checking. Just checking.
That's allowed.
All right, guys.
Everything's allowed now, apparently.
Stay safe.
All right, bye.
Bye. Stay safe. See you well. All right, that is a wrap. Our cross-platform. We call it the closing bell. You've got Bailey and Romaine continuing there on the close on Bloomberg TV. Tim and I. Wow, don't we look good there?
I wasn't looking.
We're going to continue right here on Bloomberg Business Week Daily. Guys, stay safe. We'll see you again, same time, same place on Monday.
A lot to parse here in the week that was and a lot to look ahead to in the week up ahead. Factor Friday up next after the break right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bailey Lipschultz.
And I'm Romaine Bostick. We close out another wild week on Wall Street. Concerns about, well, everything. The situation in Iran, the situation with private capital, the situation with AI. The S&P 500 at one point trading below that 6,700 line, a key technical level, managing to close above it, but down about 1.3% on the day, and even worse on a weekly basis. Travel and logistics stocks really took it on the chin here on this Friday afternoon. Energy stocks, though, continue their run. It's a modest gain on the day, but we should point out they've been on an uptrend for the last couple of weeks, largely potentially the beneficiaries of what you're looking at on the bottom of your screen, Bailey, $92 on Brent crude oil.
And we'll look at some of the worst performers in the market on an equity basis. Because of that, you're looking at Airlines Index down 13%. That's their worst weekly performance since Liberation Day last April. And I want to call out Norwegian Cruise Lines down 19%. Romaine, worst week since 2020 when the pandemic came. Also just going to call out the Mag 7 Index down, 60 basis points, not too weak relative to something like the KBW Bank Index, down more than 3.5% as those AI jitters and that private credit jitters really continuing to hit banking stocks.
Well, looking at all the red you have on your screen, Bailey, it actually brings us to our top story. Past midnight in Tehran right now, entering day 8 of the U.S.-Israeli war with Iran. What was supposed to be a quick strike and resolution now seems to have no defined end in sight. U.S. President Donald Trump today demanding Iran's unconditional surrender. Israel, it's expanding its attacks to a broader ground presence in Lebanon. Shipping through the Strait of Hormuz still at a near total halt. The most significant direct blockage of the only sea passage from the energy-rich Persian Gulf. Earlier in the week, it seemed like investors were willing to dismiss the prospect of broader risk to broad financial markets. But as night falls over Tehran with the fire of missiles, the only light in the sky, traders are now having to reposition around what's turning out to be one of the biggest and more complicated geopolitical events in years. Eric Balchunas is our senior ETF analyst over at Bloomberg Intelligence. You've been taking a look at some of the flows and some of the moves, and I am curious, are we seeing a more defensive posture as we head into the weekend?
Maybe a little bit. You know, we've been looking. One thing that we've noticed this year in particular, and it's ramped up in the past week, is more flows into fixed income ETFs. If you look at those ETFs, have taken 110 billion this year. That is about 4 times their normal take and about double the old record. That said, almost everything is in record territory. So we are still seeing flows into equities. Now, over in equities, there's been a move towards more international. So I would say, you know, that whole idea of like trying to diversify out of the U.S. that everybody was talking about last year that just did not happen seems to be happening this year a little more. I don't see flows out of U.S. equities, but I do see people buying a lot of other things, namely bonds, namely fixed income. The problem with bonds, though, is that they're down since the Iran strike. And we've found this a couple of times in the past 5 or 10 years where when stocks go down in some crisis situations, bonds also go down. This has become a big reason why we've seen a rise in buffer ETFs and other sort of creative structures designed to hedge your portfolio.
Well, Eric, if the flows are continuing to go into everything, is the money just coming off the sidelines? Just trying to think of where the outflows are at that you're tracking.
Yeah, let's look at some outflows here. So you're going to see some outflows from some of the more highly volatile areas, some theme ETFs. But like when you look at like Vanguard and BlackRock, it's mostly inflows. Now, remember, you have to remember, you guys just went over this real doomsday scenario, but people are so used to hearing that. And then what happens a week later? Everything's up. Whether it was the tariff tantrum or we can go back and back and back, there's a wall of worry every 5 minutes. So I think that a lot of, especially ETF investors and retail investors, not the traders, but the investors, they're probably going to shrug this off for quite a while. I think it would take months and months before you see any real shifts. So I think a lot of the buying and selling in the market is algos and hedge funds and maybe a couple panic retail. But the big blob of money, it will take a long time and a lot of negativity before you see those flows, just go away, panic, and pull their money out.
And I'll be looking forward to keeping up to date, Eric, with you breaking that all down for us. Thank you to Eric Balchunas of Bloomberg Intelligence. Going from one BI expert to another, let's bring in Chris Cain for another edition of Factor Friday, breaking down the factors to watch. Chris, going to keep it a high level. How factors work this week as the war rages on?
I'll give you 2 things that really stood out to me, right? One was it was a very bad week for momentum. So low momentum beat high momentum by about 5%. That's a big weekly move. If you remember, we kind of flagged this. We said that the increased index dispersion has historically led to poor momentum factor returns. That came to fruition this week. The other thing I'll mention is just an extreme lack of defensive rotation within the markets. You would think that, when you have a geopolitical event or a big risk-off event, you would see things like low volatility stocks beating high volatility, high profitability beating low leverage beating high. We haven't seen anything like that. There really is no defensiveness when you look inside the markets. Equity markets are, shrugging it off as maybe too dramatic of a word, but we're only off 3% from all-time highs. I don't see the defensive flows within the market, so it's a little bit more calm than you would expect.
There's been a lot of talk about the moves, the sharp move higher that we've seen in oil prices and energy prices overall, and how that potentially feeds into equities. What are you watching?
So definitely the biggest move, the most significant dramatic move is oil. I mean, going from 65 to 90 in a week is no joke. We looked at this, what we really found was different tranches of oil prices, specifically above $100. That's really the red zone for equities. Mm-hmm. Forward returns after prices above $100 are very poor. Things like margins you see really contract after $100 or above $100. And that's not just energy either. We even stripped out energy, and both of those things hold. So we're getting close. It's not really the increase. It's more like the level above 100 is the red flag.
All right, Chris Cain over at Bloomberg Intelligence, a closer look at the factors. And speaking of oil, our next guest says he actually had a line in the sand earlier this week he was looking for, and that was $90 a barrel. We got there today, and he joins us after the break. Julian Emanuel, Senior Managing Director of Equity Derivatives and Quant Strategy at Evercore ISI. This is Bloomberg. All right, coming off one of the worst weeks that we've seen for U.S. equities going back to October of last year. And a lot of that is because of the big spike that we've seen in oil prices. WTI crude, that's what's traded here in New York, crossing the $90 mark today. So too has Brent crude overseas. That's as the situation in the Middle East intensifies. Our next guest is closely watching the impact and says that the $90 crude level could be a potential obstacle for the S&P's path up to 7,000. Julian Emanuel, Senior Managing Director of Equity Derivatives and Quant Strategy at Evercore ISI, joins us right now. First, let's start with the oil price spike. We should point out that $90 number that you floated out there. You put that in a note a couple days ago when I think oil was, below 80. So we got there pretty fast.
We did.
Okay, we're there. Now what?
So, a couple of things.
Yeah.
First of all, there's the length of time it stays here. And if you go in the past, you usually need to be at these kinds of levels in excess of a month. But almost as important as the $90 in WTI, and if you think about it, the psychology of the consumer, they're not watching the screen. They don't know WTI versus Brent versus anything. But what they do know is what they're paying at the pump, okay? And our work along those lines shows that $4 at the pump is really a very significant psychological breakpoint. We're still a long way away from there, but again, any length of time here, and if things ratchet even higher from here, you are stressing the economy and potentially stressing the markets.
Yeah, and that certainly has to be a concern. As far as the markets, though, and we always kind of have to split up the economy and the markets to some extent. And we started off our show about an hour and a half ago with Steve Sosnick over at Interactive Brokers, and he kind of had a nice quip. He said, look, the best way to sort of look at this is how does this affect Microsoft's earnings, or pick any sort of big company in the S&P. And for right now, unless you're an energy company or a defense contractor or somewhere in that space here, there probably isn't, at least in the immediate future, I would think, no real impact on earnings, or is there?
No, there really isn't. And so just to give you a point of reference, we actually took our earnings number up last Sunday. Obviously, the conflict was 24 hours old at that point. And the work that we've done shows that actually in years where the EPS grows by 10% or more, there have been 11 of those years in the last 30. 10 of the 11 years have been positive with an average up 13%. So if you think about it, and we were talking about this a moment ago, if you had told me that oil would have been over $90 at the end of the day Friday, and yet we would have only been down 2% and change on the S&P, and actually only a shade over 1% on the NASDAQ, I would have said you're crazy, but it really points to the resilience of an earnings-driven environment.
But it makes me wonder, though, what is the next catalyst to the upside? Because economic data this morning did not instill confidence that the economy is on strong footing and that those rate cuts are on the near-term horizon.
No, and again, there's a lot of noise going on with the data. There's certainly a lot of noise given how quickly perceptions of inflations are shifting, let alone the fact that we're going to have a new Fed chair in May. But, all roads lead to the idea that you're going to expect news flow from Washington or from the Middle East. But the positive along this, and really which also explains why the market is behaving so relatively calmly with this, is that investors came into this event very, very hedged, really record levels of hedging, paying, almost indiscriminate prices for puts versus calls, on a par with what we saw at the trough of the April 25 tariff tantrum, which in our mind, it was really a generational buying opportunity. That's why we are in this range between 65.20 and 7,000.
A couple things top of mind. Goldman Sachs note hitting potentially oil being above 100 next week if there's no resolution. The semi-index is down 7% this week. We have contagion fears, at least to some extent, in private credit. The VIX is back near 30. What is top of mind? What do you look at as we go into the weekend that makes you optimistic that Monday will be better?
Well, I'm not necessarily optimistic that Monday is going to be better, because I think we will need to see some positive news flow for that to happen. But again, I go back to this idea that, there is damage being done, but it's contained because investors are so hedged, and actually they're also hedged for this level of oil. Very rare that you have such bearish positioning in terms of option hedges in the equity markets and such bullish positioning in terms of the oil markets. So in our mind, if there's any respite to the defensive narrative, you could start getting unwinds of those hedges, and that's what stabilizes the markets.
And we get to this idea, I mean, we talk about some of the levels. I know we had a lot of technical levels tested this week, and it looks like, at least based on the terminal, it looks like we did hold the line, at least on the certainly on the S&P 500. I am curious about just the psychology effect of that, too. The idea that we haven't breached some of these levels to any significant extent, and whether that also sort of plays a role in what comes next.
Oh, it most definitely does. And I think part of the real confusion is that if you look at year to date, again, within the realm of the index is really being sideways, you have had a series of what we call moonshots and crashes, whether it's silver or real estate services stocks, trucking and logistics, the Korean stock market, which really accounts for some of the weakness in semis that we've seen this week. But it's all part of a rotation. Think about this month of March. If you're an active manager, you're 2 months in, you're not necessarily going to make your year by sticking your neck out. You're probably going to take your positions down.
Hey, Julian, I need you to stick around if you can, but we do need to take a quick break here. We're up against a hard break here. But Julian Emanuel, he's Senior Managing Director over at Evercore ISI. He's going to be sticking with us. I got more to talk about here, including the big jump in yields we saw this week, concerns about the economy. Stick with us. We'll be back in a moment. This is The Close on Bloomberg. Welcome back to The Close and another volatile week for markets across the board. Still with us here in Studio 2 is Julian Emanuel, Senior Managing Director of Equity Derivatives and Quantitative Strategy at Evercore ISI. And before we went to break, Julian, you were talking about how hedged this market was heading into this event here. I do want to talk about it from the bond market side, too, because we're also seeing an increase in hedging there, hedging against inflation risk. We saw yields, of course, spike this week, largely because of the rise in energy prices. And I'm just taking a look at 5-year break-evens now at the highest level going back to March of last year here. I know there has to be a correlation between those inflationary pressures and the whole issue of earnings and at least aggregate earnings growth as well. Kind of square that circle for me.
So, again, on balance, a little bit of inflation tends to be a positive for earnings. We know that. But when you think about where the bond market's been, it really is 20, 30 basis point swings around a central tendency of, call it 4%. We were below 4% a week ago. And actually, when you put it into context with the moves that we've seen overseas, UK gilt yields screaming higher today, and Japanese government bond yields much higher in general. In fact, the bond market in the U.S. has been very well behaved, all things considered.
Has it been a good proxy, too, for, I guess, what risk, or at least what the perception of risk is?
Not as good as it was, to be perfectly honest. There's a lot more cross currents. And in fact, if you go back to last April, the whole thing was, selling of U.S. assets and, fleeing of bonds, and it just didn't prove to be the case. The reality is look, we made a major low in yields back in 2020. The yields have been rising since then, but in fact, these last 3 years, we've gone absolutely sideways. And part of the narrative as to why stocks have performed so well these last 3 years is because bond yields have been so stable.
At what point, though, does looking outside of America become more attractive? Just looking at the S&P 500, you got 24% return in 23, 23% in 25, or 24 last year, 16%. Like, these are breathtaking returns led by a Mag 7 that has carried the baton. Are you expecting people to pivot away from U.S. assets or go into the S&P 493?
So from our point of view, the process began. The dollar made what we believe to be a relatively long-term top about a year ago this time. And then you started to see some diversification after, as you said, years worth of outperformance into international, into Japan, into smaller caps, into the other 493. And on balance, That's a positive for the markets as a whole, and we think that that's a multi-year process that's likely to continue, particularly as the dollar comes under renewed pressure, which is not implicitly a negative for assets in general, by the way. But from our point of view, our view is that this bull market has further to run and that leadership is likely to be picked up again by large cap tech. So in that vein, this rotation towards the rest of the world may not happen as quickly as it happened, call it in the last couple months or in the first quarter of last year.
Julian, always appreciate it. And thank you for sticking around. Julian Emanuel, one of the best in the business, Senior Managing Director of Equity Derivatives and Quant Strategy over at Evercore ISI. Now we go from the market reaction to this back to more, I guess, so what comes next with regards to the policy decision and military decisions coming out of Washington? The President of the United States demanding Iran surrender, unconditionally surrender, as the conflict in the Middle East now entering its second week. Our next guest says, quote, by far the biggest strategic mistake that Trump has made across either term, and that it will cost him politically. Ian Bremmer is the president and founder of the Eurasia Group, as well as G0 Media, and he joins us right now. Ian, I just want to point out, early in this program, we actually had Trump's former special envoy for Iran. This was from his first term, who also happened to be special envoy for Venezuela and a lot of other conflicts that we've been in the past. I'm speaking of Elliott Abrams, and he said, look, comparing this to Iraq and Afghanistan, pish-posh, said whatever concerns you have about what's happening right now with the duration of what's happening in Iran, look away, that the idea is that we have control right now, meaning the U.S. and Israel, of what's going on in Iran, and that this will be put to bed relatively soon. Will it?
First of all, I love pish-posh, just as a general dismissive term. I'll try to use it more frequently. I agree that this is not Iraq or Afghanistan, the forever wars, and I certainly hope that we won't see boots on the ground in any significant number. Trump has avoided saying there won't be any boots on the ground, but I do think he's going to show restraint in that regard. But there's no question that when it comes to Trump's foreign policy decisions, over the last week, we've seen a significant number of things that he's not been remotely prepared for. Like, for example, how do you get the Straits of Hormuz reopened with all of the economic damage that's occurring in the United States, and more importantly to Europe and to Asia? How do you evacuate American citizens from more than 10 countries when the State Department says you got to get them out? You don't actually have a plan. How do you get adequate numbers of interceptors to stop the Iranians from being able to cause damage to allies and to U.S. hard targets across the region?
Yeah.
You apparently have to call the Ukrainians and ask them for support. All of these things, I mean, how do you get the Iranian regime out that you've said that you need to have these guys removed, and you have to have an acceptable leader? And so you're calling up the Kurds in Iraq. For example, you're saying the ones you were talking to at the beginning you inadvertently killed, or the Israelis did. This does not instill confidence, however much pish and posh you wish to dismiss it with.
Well, yes, and there's been a lot of reporting about the plan going into this, or maybe the lack thereof. I do just want to bring just to your attention, to our viewers' attention. I mean, Bloomberg has just been reporting, based on people familiar with the situation in Europe, that European leaders have been in contact with Saudi Arabia, and that Saudi Arabia has now stepped up, quote, direct engagement with Iran to try and contain this war. And it raises a question, Ian, as when we're looking for an answer to what the duration of this is and when it will come to a close, by looking at the White House, are we looking in the wrong place? Is the negotiated end to this more likely going to come from some of the Arab states or Europe, or basically someone that is not Trump or Netanyahu?
I don't think so. I think that the decision to end the war will come from the United States and Israel, because they have asymmetric military capabilities. And so essentially, you're not going to get unconditional surrender, but you are going to get the Americans and Israel saying, OK, we've won. We're done now. And if the war could really end then, and we could end the story, even though things will have gone badly and not the way the U.S. had expected, you can contain it. Here's what I'm worried about. I don't believe that the United States has the ability to remove this regime. And I don't believe the Iranian people do either. I hope I'm wrong, but right now that does not look like base case. if the Americans end the war with a regime that looks and feels very similar to what they had coming in, then at that point, the war's over, the Iranian people are going to rise up. And you know what's going to happen? They're going to get killed.
Yeah.
And these are the same Iranian people that have been killed by the tens of thousands by this Iranian regime in January, who Trump said he was going to rescue. And then those deaths are going to be on Trump, because he will have declared war on them and spent all this money and lost troops.
Yeah.
And then they're going to come back and still kill these people. So I fear that limited war that Trump ends, that the story is not going to end there. And I don't know how we fix that. Again, I hope I'm wrong.
Yeah.
And I hope we get a regime that is less willing to repress their own people.
Well,
I hope we get a regime that's willing to work with the United States, but I don't yet see that.
Yeah.
And absent that, I think we have a real problem.
Well, I am curious. Talk a little bit about that problem. And this is really the question that I think a lot of people have had, which is the idea that we have not so much a prolonged war, but a prolonged instability in Iran, meaning an unstable government, maybe factions of militias and maybe sections of the country, sealed off. I mean, what does that mean, not just for the Iranian people, not to be insensitive, but for the rest of that region and, quite frankly, the rest of the world?
Well, I mean, what you're mentioning is very different from what I'm suggesting. I'm suggesting that the baseline is that the Iranian regime is weaker, can't project much power across the region. Its axis of resistance is basically destroyed, but can still control the country. Now, what you're suggesting is that's not true. You're suggesting that, well, what happens if the Iranian regime fails? What happens if we start to see a civil war where, the Northwest Azeris start governing themselves and the Kurds start coming down and they're able to take their own territory, and the Iranian regime essentially becomes a rump state around Tehran, where its own people might band together, because the only thing worse than the regime is losing the country completely. That would mean a lot of refugees. That would mean a lot of chaos. That could mean a proxy war, broader proxy war over that territory more broadly in the Gulf and beyond. I don't think that is the baseline expectation now, but that would be a very bad scenario. That's plausible, and maybe you should go back to Elliott and ask him about that.
Yeah, I think I know exactly what he would say. And I am also curious about this idea that's been floated by the administration itself of potentially arming some of those folks, particularly some of the Kurds in the north.
Yeah, well, I would say the White House has been of two minds. They've been skeptical that it's going to work. But they also recognize that Trump wants a solution, and he wants a solution now, and so they're providing ideas. Again, I think that there are going to be American troops on the ground in the coming days. I think they're going to be in small numbers. I think they're going to be engaged in very discrete and specialized programs, and hopefully they don't experience any casualties. But I think we're going to be talking about that too.
Ian, always great to get you on here, always smart. Ian Bremmer there, president and founder of the Eurasia Group. Now, we're going to make a hard pivot there from geopolitics back to what's happening here in the U.S. domestically, particularly coming off of that major jobs report that we got this morning. It's a monthly report, and it showed a contraction in jobs of more than 90,000. It was a surprise to a lot of folks. Now, some people are saying that there are temporary factors that played into that, but there have been some longer-term structural issues going on here, particularly when it comes to women as well as minority groups and their employment picture. Our next guest, she looks under the hood and talks about that worrisome picture, particularly with the high unemployment among black women, stripping away the economy's, quote, shock absorbers. Katica Roy is the CEO of Pipeline Equity and an award-winning gender economist. And I want you to start off with this idea of shock absorber here, because we've already seen weakness in a lot of those categories in the monthly reports leading up to today. Why should that be a concern?
That should be a concern because right now what we're seeing is that about 70% of the growth in consumer spending is coming from the top 20%. And we have seen the stock market be pretty shaky since January 28th. And a lot of that top 20% are spending wealth effects, essentially paper money, not income. And if we have a large correction in the stock market, we have basically thinned out the shock absorbers, the inelastic demand that would catch our economy.
Well, I'm curious, though, too. I mean, we've heard from several retailers over the last this week as well as last week, including Target. We heard from Walmart and a few others. And overall, you're still, with the exception of a couple, you're still seeing growth, at least on a same-store sales basis, even on the amount being spent in the store on a year-over-year basis. So is there something we're missing here that isn't quite showing up in those earnings reports that is maybe going to start to show up in the government reports?
Yeah, so some of the things that we're seeing, for instance, Walmart. So the fastest growing demographic for Walmart are folks who make over $100,000 a year. And what that tells you is that their purchasing power, or at least their perception of their purchasing power, has begun to shrink. We have also seen buy now, pay later for groceries double in the last year. So essentially, people are financing their eggs and milk. And the subprime auto loan market has actually reached about 2008 levels in terms of folks being behind on their car payments. So that it should be of real concern to us in terms of who is actually going to capture this if there's a correction.
But how does that play out? If there is a correction, you're mentioning the subprime auto loan delinquencies surpassing those 2008 levels. As you mentioned, we saw Walmart catering to a wealthier consumer. Ross Stores beat expectations, and their comp sales were through the roof for the fourth quarter. What does this all end up looking like, though?
Well, what this ends up looking like is we've had a little bit of a correction since January 28th. Nothing huge, but a little bit. But we have thinned out our middle class, and we have made the bottom of what I call the barbell economy much more fragile. So, for instance, if you look over the last year at the jobs report, we can look at today, but you have to look over the last year. What we see is that for Black women, their unemployment is actually 1.6 times what the Fed considers full employment. We've also seen unemployment for women rise twice as fast as that for men. And we've seen the Fed actually inject about $40 billion of liquidity into the system since December. So all of those are indications that we're not quite on solid ground that we would think.
Yeah, and I'm just trying to think through, as we continue to talk and track what's going on in the Middle East, how that impacts oil, how that impacts gas prices, the ultimate knock-on effects for consumers. Just walk me through how you would think about the ultimate knock-on effects if this is a conflict, if this is a war that lasts for a number of weeks, and we do see some of the issues piling up in the supply chain and ultimately those costs being passed along.
We don't have the shock absorbers to really to take that on. So the American consumer, I would say the bottom 80%, is under a lot of pressure. And now with already, right, if you look at wage gains compared to inflation since the pandemic, wages have not kept up with inflation. That is before what's happened in the last year. And now you see the additional pressure of gas prices, essentially, what that would translate to, and that is getting smaller and smaller.
All right, Katica, always great to catch up with you. Unfortunately, always sometimes the dour topics to talk about, but important as well. Katica Roy is the CEO over there at Pipeline Equity. Closer look there at the state of the job market here in the United States. Now, when we come back, well, we're going to talk about prediction markets. It's a big market, and it's actually expanding. It's coming for the luxury watch space. A conversation up ahead with the CEO of Bezel. It's a watch marketplace that's going to be joining us next to talk about their partnership with Kalshi. That's coming up next here on The Close on Bloomberg. The luxury sector facing headwinds from recent economic and geopolitical pressure. Our next guest, though, has some interesting insights on the space. Given his role as the CEO of Bezel, that popular watch marketplace, it's a marketplace that now has a new partnership with Kalshi to get in on the prediction market boom. Quaid Walker joins us right now, the CEO and co-founder over at Bezel. All right, Quaid, explain to me how this works, right? Because, I mean, if I go on your site right now, I'm actually on there right now. There's a nice little Patek Philippe here, actually the calendar edition. 23, 24 grand, 1996. Looks like it's in good condition. That's from your website. What is Kalshi bringing to the table here?
Yeah, so internally, we recently built a price engine. So like the prices that you were just mentioning, our job is to build a tool for a lot of the markets to leverage to understand what a market price is for, say, the Patek that you were referencing. We built a mathematical consensus, so basically a machine learning model to analyze all of our data, all of our sales, all of our transactional moments, and then market data to put together what we think is the most thoughtful understanding of a market price. And now we're partnering with Kalshi to build markets around that data to make it accessible for folks that maybe don't want to buy, a $23,000 watch to participate in the market. They can now participate on the prediction market side that way.
Well, that's what I'm talking about. And I really called out that watch because I was hoping my wife is listening. Father's Day is coming up. But in all seriousness, I mean, like, who is using this? So is the idea that are these going to be sort of watch aficionados who just want to sort of partake in sort of playing what the prices are without actually having to commit to buy anything? Or are these going to be people who aren't necessarily even in that watch community?
We hope it's a mix, right? So I think watch folks tend to be obsessed. And so if this is another avenue for folks to participate in the watches or engage with the watches they love, we hope they're excited to do so. There's already a rumor mill that spins in the watch world, and you see folks that are speaking on forums or amongst groups of collectors about what they think is going to happen in the watch world. So we're hoping this is another avenue for them to engage that way. And then we also hope it grows the hobby, right? If you have folks that are trading on Kalshi that are interested in financial markets, we hope this brings them to the watch world and brings more liquidity in the space and ultimately just makes the watch world more vibrant and more interesting.
Quaid, how robust is this market, or how robust do you expect it to be, just thinking about people who are willing to wager on the prices of watches and how liquid it is?
It's still early days, right? And so we've seen a lot of interesting activity in the first couple of days that it's been out. And so we're monitoring it very closely. I think our job as a business is provide the data to Kalshi here. Our hope is to learn from the watch community and just evolve the partnership based on the response that we get from them. And so early signals shows that there's a lot of interest there. We've obviously intentionally picked a few markets that we thought were representative of models that trade more frequently on our platform. And so the one-to-one overlap of interest was ideally optimized there. And so we're monitoring really quickly. So far, it's a lot of really positive signals, but we'll kind of see how it continues to evolve.
Well, I just remember there was a platform, I think Rally, there may still be some around, that the whole point was you're buying shares of an underlying asset, so at least you can tell your friends, hey, I actually own part of a Daytona. In this circumstance, though, you're just strictly betting on up or down. So I'm just thinking through the incentives, other than maybe if you're a watch aficionado who believes they have better insight and can capitalize on that.
Yeah, so I think as far as ownership goes, our interest is, buy a watch on Bezel. We want to make sure that it's authentic. We want to make sure the ownership, we don't, there's no notion of like fractional ownership or anything about the partnership. Our hope with Kalshi is just, if I'm sitting here and I'm speculating on directions that the watch is going to move, can I participate in a way without requiring, needing to purchase an entire watch to play in that market? Our hope is this is a fun secondary activity allotted for collectors that are already obsessed with the category. But I think as we expand from there, the price engine that we've built is extensible to do a number of things. And so this is our first step into the space. We're waiting to see kind of how the watch market responds to it. And then our goal is to evolve the usages of it as we scale.
Hey, Quaid, I do want to ask you just in general about just kind of the health of the watch market, pretty much the resale market, if you will. Have you seen any sort of changes given some of the issues with the economy and geopolitics, or is there not a direct correlation?
Obviously, the most recent change has been the tariff environment. So we're a U.S.-only business, and we operate obviously in the secondary market. And so the tariff environment affected all goods that were moving into the U.S., especially Swiss goods were hit quite hard. So prices were synthetically moved up for the first time in a long time. So that was kind of the first order effect. And then secondary, as the primary brands start baking in the tariffs into pricing, we saw a lot of movement happening there. But that was kind of the last big mover. We haven't seen any changes in purchasing or anything happening quite yet, given like the current economic situation. But obviously, it's ever evolving, and the fun part about this price engine is that it will give us, a very close look on things changing as they change in real time.
All right, Quaid, really appreciate you taking time for us. Quaid Walker, there, he's the CEO and co-founder over at Bezel, of course, the watch marketplace now, in partnership with Kalshi, Bailey, Katie and I, we kind of joke about how, these prediction markets are just they're taking over everything now, right? I mean, it kind of started off with, just these little simple binary bets, and now you're betting on the wars, you're betting on financial markets, you're betting on sports, and now apparently the price of your watch.
Well, I remember Kalshi CEO was presenting in a Goldman environment, a Goldman conference, and he was just like, we want everyone, if there's a market, we want to be there. And clearly there is one, or is going to be one for watches.
All right, we wrap up a really busy week. It's going to be even busier next week. Let's get right to it. First of all, remember to set your clocks forward here if you're in the U.S. daylight savings time. But on Monday, we do get some earnings, including out of HPE and Vail. But Tuesday is going to be interesting. We're going to get earnings out of Saudi Aramco and Kohl's, but Oracle, Bailey, that's going to be a big one.
That'll be a big one, obviously a big bellwether for the AI ecosystem, especially after the news that we had on that Stargate data center.
We're going to get some economic data as well as the CPI on Wednesday, trade data as well in the mix. But Friday, we're going to get those PCE numbers, of course, the ones that the Fed cares the most about. And that's actually going to be just ahead of their big meeting the week after that. So please join us here on The Close next week. But for all your politics coverage, stick around. Balance of Power is up next.